Hello and welcome, and in today's video I will present the 5 key takeaways from the book The Most Important Thing Illuminated by Howard Marks. Spoiler alert, it's a very insightful book that explores the principles of successful investing and decision making in the world of finance, and is a book that I would highly recommend and is definitely worth reading. Well, thank you for joining me, and I'll see you in the next one. Wait, I'm only joking. I've not told you about the 5 key takeaways, so sit back, relax, and enjoy the show. At the time of writing his book, Howard noticed that when he spoke to people about investing in his fund, he would often say, the most important thing is A, or the most important thing is B, etc. He quickly realized that there are quite a few things that you need to understand in order to become a successful investor. And I'm going to summarize these main points in today's video. First of all, just to give you a little bit of background information about Howard Marks. In 1995, Marks co-founded Oaktree Capital Management, a global alternate investment firm. Oaktree specializes in distressed debt, high-yield bonds and private equity. Marks is known for his value-oriented and contrarian investment philosophy. Marks' investment approach often included a focus on debt, where he seeks opportunities in undervalued assets or securities facing financial difficulties. And just to be clear, my own investing stock picks are nothing like Howard Marks's, as his circle of competence is very different to mine. But the concepts in his book are universal and can be applied to anybody's investment strategy, and are essential for your own personal growth as an investor. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. Takeaway number 1. Risk and uncertainty. Marks emphasizes the importance of understanding and managing risk, as quite often people mistake that choosing a riskier asset leads to higher rates of return, but this just isn't true. Risk doesn't come from poor fundamentals, as any company bought at the right price may produce profitable gains. Knowing what a company is worth and then comparing that with its current price is where the risk lies. In order to achieve better than average results, you need to be able to identify what risk a company holds, and then deciding whether or not it is reasonable when compared to the market price, which can be very volatile and emotional when Mr. Market gets nervous about a particular issue. Such as when ResMed's share price fell sharply when Novo Nordisk released a dietary pill that has the potential to change people's eating and drinking habits. This caused Mr. Market to become somewhat concerned that the stocks that relied on fat profits, pardon the pun, such as Coca-Cola, Hershey's and Pepsi, they began to plummet. It could also be argued that rising interest rates and inflation all contributed to the nervous hedge fund managers pulling their money out of these massive companies. In ResMed's case, being a sleep apnea aid, it was heavily hit by the ever-emotional Mr. Market, as one of the primary symptoms for sleep apnea is being not thin. Getting back to Howard Marks, he distinguishes between risk where outcomes are known but probabilities are not, and uncertainty where neither outcomes nor probabilities are known, meaning that whilst high-quality companies can be a risk and low-quality assets can be safe, it's just a matter of the price you paid for them. Therefore, risk control is essential. Takeaway number 2. The awareness of cycles. Howard Marks discusses the cyclical nature of markets and the importance of recognizing where an asset stands in its cycle. He compares the market to a pendulum that swings from one side to the other. The extremes are the turning points at each end, although the midpoint of the arc best describes the average, as it spends very little time there. Instead, it's almost always swinging towards or away from both extremes of its arc, and we can be caught chasing the market because of the fear of missing out. Therefore, we fluctuate between happiness and depression, between greed and fear, and a stock being overpriced or underpriced. Every so often, investors decide that a trend is never ending, and at the time of recording this, we currently look like we're in one now. So when the good times are good, we believe that the trend will continue upwards forever and forget the risk. And when times are bad, they focus only on the negative, and this point of view is self-feeding, as they believe the downward trend will never end. Howard warns us about today's market environment and believes now is not the time to be aggressive. If you listen to Howard Marks's podcast, The Memo, he explains that we have come to the end of one market cycle of low interest and are transitioning to a new phase of higher rates which no longer provide companies with cheap leverage. Therefore, debt will become more expensive to gain a return, which in return will create a new market cycle. Takeaway number 3, investor psychology. Mark delves into the psychological aspects of investing and highlights how emotion can affect your decision making. And therefore, the biggest investing mistakes that are made don't come from the information that you have gathered, but rather those that are psychological. In Mark's book, he talks about the negative influences of greed and fear. Hang on, wait a second, isn't that why we get into investing in the first place? Anyway, well, Marx goes on to explain how when investing people can lose rational thought, dismiss logic and reason and in some cases become envious or let their ego get in the way. No, I said ego, not egon. Anyway, all these psychological forces can have a powerfully negative effect on your investing process. Successful investors are aware of their own biases and work to control them when making investment decisions. As Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. You might be asking yourself, did that quote match the point that Howard Marks was making? Well, no, but who can resist putting in a quote from Warren Buffett? Just think of the last bear market when stocks were falling and it seemed like most stocks, other than Microsoft, were going down to zero. How did this affect you? Were you nervous or excited that you could buy more stocks? Or were you annoyed? Well, yes, I was bloody annoyed because I didn't have any money to buy any available stocks when the dip came. Note to self, always have a reserve ready for when fantastic opportunities become available. Or, like recently when the market went on a bull run, did you start buying when everything started looking rosy? Well, yes, I can say I've done that too. This brings us to the next important thing. Takeaway number 4, market efficiency. To buy when others are despondently selling and to sell when others are euphorically buying takes the greatest courage but provides the greatest profits, says Sir John Templeton. Okay, yep, this quote definitely does link to what Howard Marks's point was, I think. Marx challenges the efficient market hypotheses, arguing that markets are not always rational and can be influenced by emotions. While most investors just follow the current trend, the best investors a lot of the time just do the opposite. When there's an agreeable consensus among the investment community, it means that most investors have already acted and that the current price reflects those actions. If a lot of investors have bought a stock because the current conditions are perceived as good, the price is then high. This leaves a lot of risk, but only a small upside. The opposite is also true. If the consensus of the market perceives the company to be in unfavorable positions, the price is often low, which reduces the risk and provides a large potential reward. Takeaway number 5, contrarian thinking. In this next takeaway, Marx identifies that going against market consensus can lead to profitable opportunities, if done carefully. But this isn't an easy thing to do, as it means going against the herd, ignoring the negative trend towards a stock, and having supreme confidence in your own investing process. Marx also introduces us to the concept of second-level thinking, which involves considering not only the implications of an action, but also how others will react to it. Successful investors go beyond the obvious and think in layers to gain a competitive advantage. And lastly, don't underestimate the role of luck. It is important to recognise that you can't predict the future, so if something happens that you guessed might happen, it isn't a skill that you can rely on. As with all things, eventually your luck will run out. An intelligent investor will invest in a way that limits his downside but leaves a large upside. Well, I'm not sure I agree with Marx on the last point. My lucky rabbit's foot and a horseshoe came in pretty handy with my last stock pick. Gosh, we've been through such a lot together. Thanks for sticking around. So let's recap the key points. Takeaway number 1. Pay attention to risk and uncertainty. Control the risk by working out a company's worth and compare it with its cost and factor in a margin of safety. Takeaway number 2, think about what point of the market cycle that we're in. Is the market greedy or is it fearful? Takeaway number 3, avoid psychological mistakes by understanding the fundamentals of a company. Takeaway number 4, efficient market theory argues that markets are not only rational and can be influenced by emotions. And takeaway number 5, don't follow the herd, look at the bigger picture to maintain your advantage. When reviewing the outcomes of a stock that you bought, consider whether or not you were lucky, because sometimes bad decisions can produce lucky outcomes. And finally, for the last takeaway, I think I'll have a margarita pizza and a side order of fries and a fizzy drink. I hope you've enjoyed this video. If you have, please like and subscribe to receive more bite-sized investments. In addition, please consider sharing this video with people you think would enjoy watching this type of material. Thank you very much, and I'll see you in the next one.